The Reserve Bank, as I said, has raised interest rates again today by 25 basis points to 3.35%. That's the cash rate, highest level since September 2012, which is 21 years ago. Joining me now to discuss the impact of this is Chief Economist for KPMG Australia, Brendan Rinn. I guess, Brendan, we expected the rate rise, but it was the associated comment from the Reserve Bank attached to it. There may be 2 or 3 more to come. That's probably got people unawares. Do you think that's going to happen?
Look, I do. You're absolutely right. The language that was in today's media statement was much, much stronger than what I thought it was going to be. Quite clearly, the Reserve Bank was very concerned about the level of inflation that materialised in the last quarter of last year, running at nearly 8%. And it's very much wanting to try to clamp that down and bring inflation back to its target band. Now, we had certainly thought that there was going to be another 25 basis point rise today. We've been saying that for quite some time. I had originally thought some time ago that that might be it. That might be where we stop with regards to the lifting of rates. But after the December quarter inflation data was out, I thought, OK, probably one more. But today's statement from the Reserve Bank suggests that it may even go more than that. It really depends on what happens in terms of household spending and wages. The Reserve Bank's really concerned of a wages blowout because that feeds through in terms of non-tradable inflation that's going to hang around for a lot longer.
Brendan, you just have to wonder why the bank then, back in November, and hindsight's a wonderful thing, started to come back from those 0.5% rate hikes and started on a series of 0.25. I heard my colleague Ross Greenwood earlier saying it's almost like death by 1,000 cuts. Why didn't they hold their nerve back then and keep the rises at 0.5 instead of these smaller 0.25 increases that we're now seeing?
Well, I think there's a couple of points there. Firstly, the bank is saying that it's normal for them to just make 25 basis point adjustments. And the fact that we're in a tightening cycle at the moment still doesn't change the fact that a 25 basis point adjustment is what they would normally look to achieve. The other thing is that if you think about where inflation was coming from, about 40% of our domestic inflation comes from tradable inflation, as in we get it from overseas. And what you're starting to see was that inflation had peaked, particularly in the US in the middle of the year, and it dropped from around 9% to around 6.5% by the end of the year. So it wouldn't have been unreasonable for the RBA to start to think that we should start seeing some of that tradable inflation drop starting to find its way through our own domestic inflation numbers. And I would expect to see that coming through pretty shortly as well. But what you also recognise is that about 60% of our inflation comes from domestic factors, and the single largest one of those is wages. And what we're now starting to see is wages growth finding its way through in final prices in Australia.
I'm on a variable with the CommBank. I think I'm now paying somewhere, Brendan, around 5.45. You have a lot of people in Australia who locked in their mortgage rate at 1.2 to somewhere up to 2, and those fixed rates are going to come off at various times during the year. How tough's that going to be on people, and are we likely to see the unthinkable in recent decades of people they own more on their home than they're going to be able to sell it for?
So if you have a look at the RBA data, what it shows is that, and the two numbers to really look at is what the average interest rate people on a less than 3-year fixed rate are paying at the moment, and you compare that to a new variable mortgage rate, which effectively they'll move on to. And the difference is around now 2.25%. And so if you then think about that in the context of an average mortgage in Australia, which is about $600,000, the uplift in interest costs alone, once those people roll out of that loan is going to be around $13,500. So every quarter of a point rise is about $1,500. So that's when the rubber's really going to hit the road in terms of when spending starts to get seriously impacted as each of those months tick by, and what you see is people rolling off those fixed rate mortgages and having to go onto a variable rate mortgage. Now, what's happened is Australia is traditionally a land of variable mortgages. And pretty much over time, the average is around 15% of most new mortgages get taken out as a fixed rate mortgage, and about 85% go on variable. From the beginning of 2020, that changed, and we actually had a peak of around 45% during 2022. So what we're now going to see is all those mortgages roll off, and if we think that the total loan book for mortgages in Australia is about $2 trillion, the number of fixed rate mortgages, or the value of fixed rate mortgages that happened or got signed up between the beginning of 2020 and the end of 2022 is about a quarter of that.
Dark clouds ahead. Brendan Ryn from KPMG, thank you very much. Thank you for joining us today.
Thanks very much, Steve. Thanks for having me.